everyone. This is Rob Roy of LA Wave Options, and welcome to TradeFinder Live. If you're new with us this afternoon or this evening, depending on where you are, just go through a couple of housekeeping things. We show this disclaimer disclosure. I know if you've been here before, you've seen it a lot, but we show it each and every week. If you're new, take a snapshot of it, screenshot of it, and read it at your leisure. The important things to note are, number one, we are not registered to give individual investment advice in the United States, and two, any prices that we talk about are assumed to be in US dollars unless denoted otherwise. So again, read the rest of it at your leisure, but those are the primary things. So with that, let's go ahead and move forward, and let's take a look at the market itself. And when we were talking last week, and I can use these feet to walk back to where we were last week, which is right here, and we were sneaking up towards that 362 level, and we were talking about that could act as a major point of resistance, and we also talked about how we were getting very thin. You can go back and watch last week's recording if you haven't and see all these things. Just giving you a quick refresher. I'm not going to spend a whole lot of time on this, but with the way the market was moving in a narrowing upward pennant pattern, and volume was just really kind of anemic, all those things going on. Mentioned that it might be prudent to be real careful about initiating new bullish positions. And on top of that, the last thing, and take this off so there's not so many lines to confuse you, is that we had been moving in this really nice 45-degree angle, which if you've heard any of the recordings that I've done lately, you know that that's my preferred move. In other words, what I mean by that, as far as a preferred move, is when we're looking for stock that we want to continue to move to the upside, like that 45-degree angle, because the corrections tend to be not as volatile. The moves tend to hold a little bit more, but I don't like the vertical moves. And what happened was, you can see the S&P, once we passed to those new highs, not unexpected, we were talking about how that likely would draw all the retail money in off the sidelines, which it kind of did. So moving to the upside here in a more vertical range, and you know what's happened since then. So I'll take these lines off, and then we'll draw. You can see that I have the fib retracement on there. That's for a specific reason. Boom. Right back down to the 38.2% fib retracement level. Now, if we want to look at the 10-day moving average, because we want to see if we're oversold, and I know that people were talking on the media outlets today that, oh, the market's getting oversold. Well, by the 10-day moving average, not really. We're down here, so we closed down here. A little bit of separation there, but not a tremendous amount. So can't really say that we're that much oversold. The question becomes, do we get a little bit of a bounce here? We could, because that 38.2% fib level could act as support. It's a decent fib level. It's not as strong in my mind as 61.8, but it certainly could give the market a little bit of short-term support. I do feel, and this is just a feeling, so that means nothing, that we're going to come down here towards this 61.8% level. So I think we come down here at some point. And just, do we bounce first? I didn't really think we'd have 3 bars like that once we reach this level. I thought it would be a more bit of a organized downward move rather than the type of volatility that we had back in March. And we're a long way from that, obviously, but it's just 3 down days have been pretty significant. But I think we make our way back to the 61.8% level, testing that wave 3 high. There's a lot of support there. Then it becomes a little bit more of an unknown as far as what happens from that point in time. But I had mentioned in the last S&P YouTube recording. And by the way, when you look at our YouTube recordings, you can see the different ways to follow us on social media. It's right under the video there where the first commentary is before we get to the comments, etc. And I mentioned the fact that I thought 38.2 was the first stop. and then we'll see what happens from there. So that's where we are, and there really isn't a whole lot more to talk about the market itself. But what I did want to talk about is the U.S. dollar. The U.S. dollar is interesting. Look at that bounce up today. So we had the wave 5 move to the downside, and that's interesting. Something seems like it's going to give. Now, this is not unusual at all from an Elliott wave pattern. So if you're looking at the 5-wave pattern on the dollar, you're like, okay, well, we had a 100% extension on the wave 5. We're bouncing back up, and we broke past 100%. So that means that was an extended wave. So now we have to do the fib retracement level because the target is not all the way back to the previous 4. So in this point in time, the target would be moving back up to 95. So the expected bounce in the dollar would be back to here at some point. Doesn't mean it has to happen immediately. It's odd that the dollar is moving back up with the type of economic weakness we have. All of the economic reports recently have been not so good. I know that they added jobs, but a lot of them were temporary, census workers, et cetera. If you really look behind the scenes of the jobs report, wasn't all that stellar. And I'm wondering, is this foretelling that maybe the Fed is going to disappoint at their September meeting? Because remember, they've been telegraphing pretty much that they're going to start some sort of a new form of QE at their September meeting. You wouldn't think that would be something that the dollar would be rallying into, but we'll find out. I think if the Fed, because the market, a lot of the market pundits, maybe this plays into it a little bit, who knows? I mean, the market is following Elliott wave technicals pretty much to a T, and we're talking about a decades-long pattern that hit within just a couple points and bounced down. But as far as where the actual market goes from here, it's one of these two is going to give, I guess, is the point that I'm trying to make. Let's take a look while we're at this. Let's take a look at gold. Everybody always wants to look at gold, so I'll save you the trouble. We'll go ahead and take a look at it real quick. And that's what you would expect to have happen with the dollar rallying, is the metals moving down, but check that out in that pattern. So we've got a really nice descending triangle with the gold. I've talked about this a lot of times, how gold is just, or GLD specifically, is one of those symbols that consolidates and breaks out and consolidates and breaks out. Well, it looks like it's about ready to move again. We had the pattern in silver, which broke to the upside and has come back to test the breakout. Which way does GLD go? It's going to be fascinating to see. But at least these two are in line with this moving down. And if you really get to the correlation, you would think, okay, if the dollar's rallying, the market's going down. That part makes sense. What doesn't make sense to me, just to try to be specific, is the dollar rallying with the September Fed meeting coming when the Fed has been guiding us to expect more QE, which would be obviously bad for the dollar. You would think, well, weak for the dollar, dovish, whatever you want to call it. So I wanted to show you the dollar and the market. And at this point, let's go take a look at, we closed a case study for our subscribers today. So I wanted to share that with you. And that was on DRI. We sent this out as an entry on July 28th. You can see by looking up here at the, this is just, I was actually kind of excited to be able to show you this one, because this is, boom, a perfect example of what to expect in the volatility strategy. This is a classic trade. This is what happens the majority of the time. So we have the odd ones that make 100, couple 100%. Those are rare. They don't happen all that often. We enjoy them when they do. And if we get a couple of those a year, we're really happy. but this is right in the wheelhouse of what normally happens. 41 days in the trade and a 44% gain. The average return on these is 30 to 70%. We have all the data to show that since our inception, that's the range that we've been in. And then when you take a look at the mark-to-market dot plot, you can see we did get a little bit of bounce into the positive range, but then negative for a while, kind of a double bottom down there on the negative area, which is interesting. Technicals play out in all kinds of different ways and areas. But I wanted to emphasize, because when you put on one of these strangles, I've talked about this before, but for those of you that are new, when you put on a strangle, by the very nature, you're buying a call and you're buying a put, and you're buying all extrinsic value, so time value is included in there. By the way we structure them, time value is not quite as severe as it would be if you were buying at the money options, but it's still a factor. So before these stocks move and break out, they're likely to show a loss, and very likely to show a loss the very next day. And if you have a few of these on and they're all showing a loss, then that kind of makes you question, well, what am I doing? Is this really the right place to be? But that's the nature of the trade, is that it's going to show a loss until the breakout occurs, and then boom, then you get the big move higher. So we had a little double bottom down here, around a 40% drawdown, and then boom, the big move to the upside. And so we went ahead and took the gain, and the exit was sent out today. So the entry, I wanted to show you the detail that we show you on the charts with our alerts for our subscribers. And really nice Elliott wave triangle here. You can see just about as classic as one can form. So this whole example was really classic. So we had the very nice symmetrical triangle. Don't know which way it's going to go. It did end up breaking to the upside, which was interesting today, because if you look at our exit chart, take a look at the upper right-hand corner of the chart, and you can see that when we sent out the alert to exit this, the stock was up $2.55, and we were right against resistance. But I want to highlight the pricing of when we got out at $2.55, because DRI finished down 16 cents on the day. So it pulled back that entire $2.50 that it was up earlier in the trading day. So the indicators were showing, don't necessarily think this bounce is going to hold. Let's take advantage of it. And there were a couple things to look at. The CCI was one, which I always look at when it comes time to exit, to try to time it best as possible. But from the chart, and again, look at the detail that we send out just in the charts, because we want to educate you on every alert. And you can, hold me accountable as far as, okay, this was the reasoning when we got out. Going back and looking like a week or so, if the stock's 20 points higher, you could have said, oh yeah, you should have waited. But it wouldn't bother me if you gave me a hard time about that, because I learned a long time ago that when you exit a trade, you take your profit, regardless of what happens from that point forward. If you were happy with the profit at the moment that you took the trade off, no matter how far the stock moves, maybe in your direction after that, you can't go back and second guess yourself, or you'll just drive yourself nuts. You can't do that. So be happy with the trade, make a nice gain, did what you were supposed to do, follow the rules, move on, move to the next one. But this stock was retesting resistance here, or retesting resistance from back in early June, as you can see, and 3 days in a row, the highs have hit that. If we break above this level, which is just roughly 92, there's a great chance it goes back to 100. But there's also a chance that that resistance holds if the market gets weak. So take everything into account, not just the technicals on the individual stock, but you have to put the market itself in the mix as well. And then on the ADX, you can see the ADX was moving up, and you're like, well, the ADX is saying we're going to break through that level. Well, maybe we do, but the other thing is that the positive directional indicator has broken below it. So the ADX is above the positive directional indicator. When that occurs, it tells you the strongest part of the trend is over. It doesn't mean that the whole move is over. It still could go higher, but it means the strongest part of the move is over. And if the strongest part of the move is over, right at a pretty decent point of resistance, then you risk the stock at least bouncing down a bit before turning around and going back up if it wants to do so. And then look what's what happened to the volume on these last few days when the stock has moved up towards that resistance. Volume is just falling off a cliff. So when you take everything into account, and that's what you do, I mean, you don't rely on any one signal or indicator. When you take the whole system into account, the prudent thing to do for today was to take that gain. And as I said, the number of days in the trade is right there. A little over a month is our average of time in one of these strangles. The percentage return is right there. And the profit loss mark to market dot plot, as I like to call it, was right as far as an average position as well. So if you're wondering, there's been some comments on the internet and stuff about this strategy. This is what you can expect. People, are curious as to, well, how does it work and what happens with it? Well, this is it. Now look at this trade. Now this is also another classic example of the way we set up a strangle. Look at the strike for the call was a 95 strike. The strike for the put was 60. So we were way out of the money on both. And that's how we set these up based on the delta curve to where we put the delta in our favor, delta and then gamma, which is the speed of the movement of the delta. So we're in the spot on the delta curve where there's the fastest acceleration. The gamma comes in and the delta accelerates the fastest. We're not trading like a normal straddle or a strangle. Straddle is both options at the money, strangle one strike out of the money. You can see we're way out of money on both sides, and yet look how well it worked. And this was not, I mean, you would agree, wouldn't you? This was not a massive move. So that's the other beauty of the way that we do the strangles. All we need the stock to do is move. It doesn't have to be that big of a move. Just some sort of a movement, and we can generate a nice gain. And when you're not, with a straddle, you have to have a decent sized move because you've got an at the money call and an at the money put. One's making money, one's losing money. They're canceling each other out for a while. Well, we have one option making money and one losing money, but the one that's making money is making it as fast as possible, and the one losing money is losing it as slow as possible. That's the difference in the way that we set it up. So we don't need nearly as much of a movement to generate a nicely profitable trade as someone that would be trading a straddle. Maybe you're tired of hearing me talk about that or stuff. I guess I still have a thorn in my side about it because that was the one strategy that was taught to me in business school, was a straddle. And it's one of the most difficult trades to make money from, and just don't understand why they would teach that. So that was an alert that we closed out today. But again, I wanted to share that with you because there was so many things that are important to what you can expect from this strategy as a subscriber. All right, so let's go back to the chart and take a look at our case study consideration from last week, which was MTOR. You can see we hit this 62% wave 5 extension. So right at the fib level of 61.8, obviously going to act as pretty significant resistance. So if we go back a week, you can look at it and say that, well, it really didn't do much. And it really didn't do much. But last week we were at 23.95, and now we're at 22.78. So it has dropped over $1 in a week, which is not bad for a $24 stock. The opposite side of the coin is that, boy, the market's really been pretty weak the past 3 days. You might have expected this one to do a little more to the downside, and I can say that I would be in that camp, and that I expected maybe a little bit more of a drop out of the corrective pattern, but it is what it is. It is moving the right direction, and maybe it just takes its time, or maybe from here we make a significant move down. Now you can see part of what's holding it up, right? So we've been hitting the 50-day moving average. That royal blue line is the 50-day moving average, so that gives you the indication. We're trading below the 10-day and right on top of the 50-day moving average. So if the stock breaks below that, that could be the go signal to come all the way down here and retrace to the previous 4, which is the expected target move on this stock. So again, better than $1 move on a $24 stock is not so bad. but you could have hoped for more considering how weak the market was. There was a comment on YouTube regarding Tesla, so I wanted to go through and show you that because we did talk about this last week, although we talked about Tesla in most of the trade finders because everybody asked about this in the Q&A, and woo, that's brutal. That's pretty rough. And last week we talked about 360, that it may come back down here and test this area, was what we're talking about, and boy, we even blew that away. But this is the problem, and the volatility is through the roof. But this is the problem with a vertical move. Talked about the fact that I like, see this 45-degree angle move. You can say, well, the stock was much lower, but it held. That move held. And then we came up and we went sideways, but then as soon as we went vertical, you go straight up. Quite often you come straight back down. So when you ask me in the Q&A about these momentum stocks, which happens quite often, it's difficult for me to get behind those kind of moves. And think about the people that bought into this post-split. So it splits 5-for-1, and following a 5-for-1 split, people obviously piled into it because it exploded to the upside, and now they're looking at some pretty significant losses with the move down. So today's news was that, you know, the S&P is like, yeah, no, we're not putting Tesla in the S&P 500. You know, that was the catalyst that sent the stock down today. If you're wondering what happened. So now we are getting a little bit oversold on the other side. Literally on the close, broke below the 50-day moving average. It's pretty amazing and just tanked that far. But you can see where we closed today and the 10-day moving average. We may get a little bit of a bounce out of this from an oversold condition, a little bit below the area where I thought it might find a little bit of support. But wow. Didn't necessarily expect it to happen that fast, but you can see you go straight up, quite often you come straight back down. I used to use the analogy, and again, the Space Coast thing, you know, the launch pad effect that I talked about on the sideways move, but when a rocket goes up, you know, if it doesn't make it to orbit and the engines quit, it just kind of turns and straight back down. So go straight up, turn around, run out of gas, come straight back down. That's what happens. So that's Tesla, and it's just another. So tonight we have some charts that are good illustrations of some of the points that I've been making for weeks and weeks, and this is why I just can't get behind vertical moves. It's 25 years of watching this happen. It's like, stay away. Now, do I miss some, you know, gargantuan momentum moves at times? Yeah, I do. But if you go look at our performance on our website at ewotrader.com, I'm happy just to, this was the comment that I made back on YouTube to somebody that asked a question. I'm happy just to take a piece out of the trend. The whole idea of Elliott wave is not to pick the exact top and bottom. I couldn't care less if we hit the exact top or bottom. What we're trying to do is determine what's the likelihood of this move, this wave, this corrective zigzag, the triangle, whatever. What is the likelihood of this continuing? Is it enough to where it garnishes putting on a trade? Never expecting, okay, now we're going to stay in this till we get to the very top. That's if you start to trade with the idea that you can pick bottoms and tops, or if you buy into the BS on the internet of how do you keep nailing these bottoms and tops these people talk about, fool's game. Doesn't happen. Doesn't happen. Nobody does. Nobody picks the bottoms and tops consistently. I think Elliott wave is probably the best individual indicator out there. That's the one that I rely on, but that's not the goal, to pick exact bottoms and tops. It's to generate profitable trades within a wave movement. That's what we're trying to do, and we've done a pretty good job at it. All right, so at this point in time, now we'll move to looking at the pre-computed. If you are an Elliott wave options subscriber and you use ProfitSource, these are already put in for you, which are the parameters that I use for finding directional moves and consolidating stocks. So the guys at ProfitSource put those in for you, so you don't have to. You could program it yourself. It has the ability. So if you have your own set of indicators, you want to use the software, you can program in your own system. You got one you like, great. I think just find a system that you like, that you trust, and stick to it and get really, really good at it. So if you have your own set of indicators, you can program in there and run the searches as well. It's just they put this in the pre-computed list, so you don't have to wait for the search to run. Normally you put the indicators in, and then you hit the start button, and it runs through the list of either the entire market, optionable stocks, whatever you want to search. You can search sectors, you can search other lists, whatever you want to do. So you can see with the consolidating stocks, there's 122. I find that pretty interesting with where the market is right now. I expect with that drop off, I mean, this is updated for today, but I expect that to probably move lower. I think that's actually pretty exciting that there's that many stocks that are still in consolidation mode with the 3 days that we've had in the market. I think that's a great opportunity, and that's what we're going to be doing for our subscribers likely throughout the rest of the week, is putting some of those positions on. Notice on the impulse, zero, nothing. And I know that through TradeFinder, until last week was the first time that we did a corrective stock. Up till that, I've asked about doing consolidating ones. We did votes, stuff like that. Everybody always wanted to do directional trades. And so we did directional trades, and we didn't have a loser. We had one that gave us problems for a bit, and then it decided to get in line. So we haven't had a losing directional trade. That's pretty amazing. And so far, this corrective trade looks good too. So let's take a look at the corrective list now. And since I don't have to ask you because there isn't anything in the impulse to look at. First thing I usually do is I take a look. I want to look at this one, Nxpi. This is one that some of the market pundits have actually been buying this. They've talked about it on the financial networks, that they've been buying this. They've been using this move to the downside as an opening to buy this stock. Now, maybe they have a really long-term view, but when you look at that chart, that one's a little bit difficult at the moment to consider going long on. So this thin dark blue line here is a displaced moving average. So if you're new this week and you're not familiar with the displaced moving average, it's a 6-4 displaced moving average, and the low means that it's off the low bar, because what we're trying to do is find out if the stock has corrected enough to consider this as a corrective move back to the previous 4, or is it a correction and a potential zigzag back to the upside? Could be either one in the corrective search. Just we're trying to find this corrective impulse move here is the idea of the search. So when you take a look at that move, the wave 4 setting up here, the displaced moving average being 6-4 means that it's a 6-day moving average, so it's a short-term moving average, even shorter than the 10-day moving average, but it's displaced 4 days, so it's moved out 4 days. In other words, what the software does in a displaced moving average, it says, okay, well, where's the 6-day moving average? That's calculated. If everything stays the same, where would the 6-day moving average be 4 days from now? So it kind of gives you an early window of, is this stock ready to make some sort of a corrective move? That's the idea of a displaced moving average. And in this case, you can say, yeah, maybe we had a doji yesterday, but boom, back to the downside today. So, you know, that very could have easily bounced back up, but it didn't even think about it. It literally gapped down throughout the trading day, moved up and closed the gap, closed lower, but the target is not too far away. So we would be looking at 116, roughly where the previous 4 is, and we're at 119 now. $3 move in a $120 stock is probably not enough to get you excited. Then we come down here and look at the DMI. The ADX is moving down, but remember that's lagging a bit. It was following along with the upward move. So this stock is really kind of in lockstep with the market, with the move to the downside. Not unlike the MTOR, but again, you can see why. It's sitting on the 50-day moving average. With this one, a little bit of a move down here. I don't think that's going to be much of a trade consideration. But that ADX, my point was, it takes a while for it to unwind the bullish position and then start to move back up to give some confirmation of a downward move having some degree of strength. Maybe it doesn't. Maybe we come all the way down to the previous 4 and the ADX continues going down and has really no interest in this downward move. And if we came down and held that support at the wave 4 and then bounced from there, move back to the upside, well, that could be a good entry signal. For those that are getting into it now, it's difficult to imagine that. Now you can see that we had nice 45-degree angle move here, so bouncing up and down, so you get above let's put the 10-day moving average on there. You get above the 10-day, you come back down. You get above it, you come back down. Perfect example of how no security in any time frame is very far away from the 10-day moving average. I say that all the time. And so here, maybe just a tiny bit oversold to the downside, but you just don't have the wild, volatile corrections with that kind of a move. Down to this previous 4, that might be it for this one. So, all right, enough said for that. Let's go back and see if we can find one that maybe has Texas Instruments. That one was moving higher, and again, boom, you get the vertical blip, and then back down. The ADX had gotten to the point where it was getting outside the positive directional indicator. We looked at this as a potential bullish position, and so now to see it breaking back down below that 10-day moving or 6-4 displaced moving average. Where's the 10-day? It's below that as well. A little bit of support there at the 50-day. But if the market stays weak, that 38% wave 4 correction is beautiful. So that is probably where Texas Instruments is heading from this point in time. We've got a cross between the 2 directional indicators. Again, the ADX is going to take its time to get its act together. But that's why you have all these other signals, the positive and negative directional indicators within the DMI, because the ADX is slow. So we use those to give us a little bit of a quicker signal of what's going on. Yeah, well, let's look at ASHR, FMC, and Google. Metals. Gosh, I just don't know if you want to get in front of the metal thing with the Fed meeting on the horizon. So there's ASHR, which is the ETF or the China 300, basically just broke below that displaced moving average today. Didn't quite make it to the wave 5 target. And you can see this is, you look at this Elliott wave pattern, you're like, okay, well, we're moving up and we're going to go to the wave 5 at 38. Never did the DMI give you confirmation of that move. That's why I like this as one of the primary and confirming indicators. If you watch the TradeScan series, you know that we went through an entire webinar on each of the indicators that's in the confirming search that I utilize, with the DMI leading the way as the favorite of the bunch, but the other ones are all, they have their spots and they're designed to, their strengths offset the weakness of other ones. But the DMI never gave you any sort of an indication that there was strength behind this upward move. So if you have an upward move with no strength behind it, reasonable that it's going to reverse rather quickly if given an opportunity, and the market has certainly done that, given an opportunity. So 29% wave 4, only a 35%, we can even make it to a 38% extension there on the wave 5. So I'd rather see that before looking at a retracement back to the previous 4, but that could be where we go. The ADX is like, whatever, we have no interest in this stock whatsoever. FMC is one that shows up on the searches quite a bit, and you can see where it easily shows up on the consolidating side. You can see how this stock just doesn't do a whole lot. I mean, it's just boring as can be. It doesn't do much, but it's broken below there, and that's about as much volatility as you see out of this. I mean, it reacted a little bit to the big drop after the COVID stuff first came out, but in general terms, it's not a very volatile mover. Target price would be the previous 4, but with this stock, it could take a year to get there. So I don't know if I'm too excited about that one. Now Google we know can move, so let's take a look at that one. Yep, Google can move. So we got a kissing right here of the 2 directional indicators. So this is a no-go for a case study consideration today. You have to have a distinct cross. And you can look at that and say, well, look at the angle of the negative directional indicator line. Look at the angle of the positive. They're going to cross. That happens more often than you think, that they come together and they kiss and then they go back the opposite way. So they come together, well, see ya, and they go the other direction. So you can't count on that, even though with the angle of those 2 moves, you would think, all right, well, another day or 2, they're definitely crossing through. But we need to keep an eye on this one. We had put this one was always on the watch list for anything bullish. We just couldn't get the trigger right on the bullish side. Now we're flip-flopping and we got it on the watch list for negative. Maybe it gives us the trigger signal here. Broke close below the 50-day moving average, which is fascinating to me. But you can see this last little flip here, and then boom, right back down. That last little blow off top kind of thing was when that, I think, is when the retail traders poured in, not just for this, but the market in general with this vertical move was retail traders coming in at the very end and left holding the bag, as they quite often are, because they come in too late. This move back here to the previous 4 at 1400, that's another one of those whole numbers, the Star Trek tractor beam type of effect. We are just a touch oversold from the 10-day moving average here. So we'll be leery of doing anything necessarily tomorrow. The future's crazy. After the down day, the future's literally gapped to the downside. But they've rallied back and are up 2 points, 2.5 points at this point in time, which is nothing. So again, I will be surprised if the market continues down with the volatility that it's shown the past 3 days. But I didn't think it would move down with that kind of volatility before. I thought we'd kind of bounce around that 360 level, being such a big, important belly wave level, with it being the, if you're not familiar, if you haven't watched the YouTube videos, it was a wave 3 top of a super cycle, which means you go back decades to find potential long-term targets, and it came to fruition. We talked about it back in our outlook for 2020 in January. That's posted on YouTube as well. You can go back and see it. So I'm not Monday morning quarterbacking you. It's there. It's posted. It all was there. And then we still had the COVID stuff. Still went back and hit the target right around the same time that we had looked at as a potential for hitting that move. So go back and watch it if you haven't already. But as far as Google itself, if we get this crossover tomorrow, even though I actually would like to see a little bit of a bounce here, because if we bounce back up a little closer to that net, we're not that far away from the 10-day moving average that we couldn't go down again tomorrow. That could easily happen. But I'd love to see a little bit of a bounce and give us an opportunity to get into a potential downward move back down to 1400 if the market is going to stay weak, but the signal isn't there for today. So far, the best looking one is Texas Instruments for a move back down towards 121 or 2 from 136. That's a decent move, but that looks good. Let's see what this. Yeah, CCI is not super low, so money flow moving hasn't broken the zero line yet, but that's okay. So that looks pretty good so far. And take a look at one more, and then let's look at Ryanair. The airlines, how are they going to survive? If you've flown at all or looked at prices for air flights, I was looking at them over the past day or two. It's pretty interesting to see that we have lots of capacity being cut out that was there just last month. So I think what the airlines are doing is they are gearing up towards the end of government funding on October 1st. That's where you're going to see all the layoffs in the airline industry. So watch for a bad print coming up on the jobless claims when the airlines lay off all those people. And they offered a bunch of them early retirement. I've known a few people that have been long-term pilots that took advantage of that. So you've got people that are going to be taking early unemployment, but you're going to have a lot of people, I think, filing for unemployment as well as the airlines all bail. But they're already preparing for it. They're cutting out days, nowhere near as many routes, not as many people, airports. They're a mess. So taking a look at this from a fundamental standpoint, again, we don't talk about fundamentals very often with Elliott wave options, because a lot of times you look at, well, how the fundamentals justify this? How the fundamentals justify any of the move to the upside? It wasn't. It was Fed liquidity that did it. But anyway, little bit of a triangle right here. Crude one, it's not very well formed, but little one right there. The negative directional indicator has fully crossed. So if I expand it here, you can see that it did indeed cross right there. And the ADX is diving down with this little bit of a symmetrical triangle. That one could be pretty interesting as well. I don't think I've ever traded this one. I don't know what the options look like here. It shows up a lot. It's got some liquidity, not a lot, but people don't like October for some reason. It's got good liquidity in September, which you'd expect being the front month. Nothing in October. There's no November options, and then there's some decent activity and going out to December. So it's fascinating, and the majority of the open interest in December is on the call side. I wonder how long ago those positions were picked. I mean, you normally would think going into a holiday quarter, that's great for the airlines, right? But maybe not so much now. So on the put side, the spreads are pretty wide and not a lot of liquidity. So that makes it a bit tougher. So I would say that we look at Texas Instruments. As our case study consideration as a corrective trade for this week. And we'll continue to monitor MTOR as far as how that trades as well. And I'll go ahead and take a few questions and then we'll wrap things up. How is Apple looking after the recent fall? I think there's a lot of pretty ugly charts out there, and Apple's one of them too. But see, this is just what happened with these stocks at the end when the retail money came in, right there towards the very end. Everything went vertical, and they just don't hold. Those vertical moves simply don't hold. And so, isn't it fascinating? it never ceases to amaze me, even though it happens all the time, and it's happened I don't know how many times over 25 years, of how long it takes for a stock to move up, and then how quickly it can give back weeks and months, sometimes years worth of gains, just really quickly. So we're all the way back down now to where we were in early August. So we gave away in 4 days all the gains that we had in 4 weeks. Is basically what's happened. So 4 days erased 4 weeks worth of moves. And if you've heard me speak before, you know that's concerning to me, and I also find it fascinating that we haven't, software hasn't labeled a wave 4 yet, but the wave 4 is pretty much in line with where closing that gap would be. That would make a lot of sense, and if I was wanting to be long Apple, I think that would be a great time to look at going long the stock. We could get that gap closed, come down, get the wave 4 in place, then maybe we can sell things out and begin to turn back to the upside. In the last YouTube video, and you can get on there and leave your comment if you want as well, I did my analysis and asked, well, what do you guys think? What's your opinion on where things go? I'm always the one out there putting opinions out. What do you think? Where do you think things are going to go? And so there are a few people that think that this pullback is just that. We're just going to pull back a bit and then we head back on to new highs into the election, and maybe that happens. My first stop was 38.2. We got there today. I didn't think we'd get there in 3 days, but we did. So I just think that eventually we hit 61.8, and maybe sooner rather than later, by the way things have been going. But as far as Apple's concerned, filling that gap, creating a wave 4, labeled wave 4, with a good Fibonacci retracement number, I think would make a lot of sense. Well, David, thank you for the comment. I appreciate that. As far as the calm, it's just putting a lot of faith in Elliott wave over time, really, is where that comes from. Question from Rama: are we in recession if it goes to 100%? And I'm sorry, I'm not sure what specifically you're talking about. If what goes to 100%, are we in recession? Recession is defined as 2 negative GDP quarters in a row. Wow, some of you guys are leaving some nice comments. I really appreciate you taking the time to do that. Question on the DRI trade. Why didn't we hold the put? So that's a good question. For our subscribers, this was a strangle, remember? So we had a long call and a long put, and remember we showed the chart on the website with all the detail we give. So we ran up here. We're at a major point of resistance. Why didn't we hold the put? There was a lot of premium still in the put. So normally my decision point is around 35 cents. If we get 35 cents or more in the majority of cases, then I'll go ahead and close out the entire strangle. That's enough money to warrant closing it and taking it. If it's less than 35 cents, it's almost a given that we'll hold that option as a lottery ticket, especially if we have a lot of time. In other words, if the stock reverses, you take the one side off. In this case, it would be taking the call off. If the stock reverses, then that put's going to regain value. If it's more than 35 cents, then, again, I've already considered going ahead and taking it off and closing it out. In this case, there is the potential for DRI. Too many signals, as I showed you on the chart, that gave cause for this to act as resistance, but the stock can do this. And that would be a nightmare at this point in time. It's just going to erode all the premium out of that put if it decided to pull one of those sideways moves up here right underneath this resistance area. Now, the other side of the coin, again, it could pop up and go up towards that 100 area. That wouldn't be good for the put either. It would erode the value. So it's a good question, and that's kind of the 35 cents is like all right, if it's above that, majority of the time we're going to close it out. If it's below that, the overwhelming majority of the time we're going to hold it. So that's where the decision line is, but that was the reasoning in this case. That's a good question. Back to Tesla, could we expect Tesla to get to 61.8? Yikes. Woo, I hope not, but it could. It certainly could, because there's two gaps there. Well, there's a lot of people actually that were on the financial networks today. I mean, they're not going out on a limb here, are they? But a lot of people are calling for 280, coming back right here to where all this consolidation was before all the split stuff and the talk of going to the S&P and all that stuff happened and it went vertical, which also happens to be, again, where the wave 4 is. So do we make it down to 250? We could. Just don't like that vertical stuff. Really good question, Steve, on the Chaikin money flow for TXN. Chaikin is more of a guide. It's included in the confirming indicators because I like the indicator for what it does, and what it does is show divergence. That's the primary thing. Remember, everything has its place. DMI is primary for directional strength. CCI is short-term, overbought or oversold, which that's the weakness of the DMI. The DMI is not short-term, it lags a bit. CCI comes in, fills that void. The money flow is pretty quick to respond because it's day by day, and you want to see divergences so you can see differences in trends of where the money flow is going. So see how these indicators are all different, but they kind of meld together to create a good system. DMI is the one that I put the most weight on, but the Chaikin money flow, yeah, it would be better if we saw that break below the zero line. But you could argue there's some divergence with the fact that the stock's going down and the money flow is still green, but it's not very green. So that's really not the kind of divergence you're looking for out of the money flow. But as far as confirmation, rather than being a contrarian indicator as it is with the divergence, so to confirm the move, you would want the Chaikin money flow to go negative. It just was the best one of the ones that we looked at. There isn't one that I'm super keen on. The two latest ones that we did for our subscribers were SBUX, which I do think is still, we got the doji here, so that could give us a move back to the upside tomorrow. The reason for SBUX with a bullish position, you can see it hasn't moved nearly as severely as the market has, is the international play. Like it or not, international economies are coming back better than the US is. It's just a fact. And SBUX is opening tons of locations in China. So that factored in from a fundamental standpoint, supporting the technicals of a wave 5 that is broken above the previous 3 and that high that we made there, and then a 72%, which is kind of in the middle on the wave 5. A little bit of a drop down as you would expect from the positive directional indicator, so we'll keep an eye on that. ADX looks good, but remember we want that positive directional indicator above it. So we've been pretty selective on any new positions. The only two new bullish ones that we've put on for our subscribers were SBUX and Nike, and you can see why on both of them. Both of them nice moves, both of them hanging in there relatively well. Nike actually finished to the positive today. It was actually up on the day, considering the negative move. And so it just, when you have your indicators on there and you trust them, the majority of trades go with the trend of the market. I don't think we're in a downtrend per se yet. We're still technically in corrective mode. But you can see that we've got the only two bullish positions that we put on have greatly outperformed the market, and we do have puts for our subscribers as well, in case this thing does really accelerate to the downside. If we break below 61.8, then it's concerning as far as the market itself is what's going on. We'll see if that happens. But that's it, top of the hour. Thank you so much for your attention. I hope you found that informative. I was excited to present this session to you and give you a really good idea of the process that goes into the alerts and the signals that we send out to our subscribers. And you guys ask about a lot of the positions that we have alerts for our subscribers. So if you're a little bit confused about where things go, come along with us. It's easy to subscribe. We don't ask for a contract. We don't ask for a month or a year in advance. It's month to month. You just try it for a month, see what happens. Take a look at the website, ewotrader.com, see the performance. Nice day, a nice month that we had in August. It was a great month. Thanks for your attention. See you next week. Take care, everybody.